Hang Seng market is where we are seeing a big cut. It's a 4% slide there, actually.
The Nifty, it is an emerging market, and to my mind, the consensus is still negative on emerging markets.
Today's standout is on Apollo Tyres. In fact, there has been multiple upgrades of late, and today UBS has gone ahead and raised the target price on Apollo Tyres to 355 versus 295 earlier.
JP Morgan has turned constructive on oil marketing companies. In fact, they've gone ahead, upgraded HPCL to a buy with a target price of 285 rupees per share.
18,479 is where we are already at after a lower start. So this is pretty good.
Markets are saying that India will grow much better to the rest of the world next year.
After 5 years today, we have approved an insurance company by the name of Shema General Insurance Company. So that's a matter of great pleasure.
We are doubling capacity in the auto business, and that's something that is based on the order book that we have.
Currently, we're up 50 points on the Nifty, 18,550 plus on the Nifty.
Nifty has actually hit record high. It is at that 18,599 mark as we speak at the day's high.
The good thing about this whole move has been the broad-based participation.
Right now, it has come off from those levels, but still comfortably sitting at that 18,596 mark.
Well, we've been waiting for it for a while, and it finally came today, and we made a new all-time high on the Nifty. Well, hello and welcome to a fresh new edition of Closing Bell. I'm Prashant. With me, my colleague Rima here in the studios, and Nigel will be with us from outside the BSE. That's the Bombay Stock Exchange, next to that bull outside the BSE in just a bit from now. But it's looking good. I mean, overall looking good. I have to say a few things though, and we'll talk more about what, now that we're at new all-time high levels, what next and the road ahead, etc. But for now, this is a completely Reliance-led move today. I mean, the latest numbers are this. The Nifty is up 80 points, and Reliance is contributing. Let me refresh this. The last it was 70 points. Yep, 70 points. 70 of the 79 index points on the Nifty are coming in from one name, Reliance. I mean, that is as one-sided or one stock-sided as it gets. So absolutely quite amazing that this is happening. By the way, volumes, there you go. That's what I'm talking about. It makes it absolutely clear. 68 index points in the Nifty, and the Nifty is up 75 points, right? So it's just a big move. Volumes also on Reliance, I mean, are at a 5-month high. You've got to go back, and we still got 1 hour to go, and volumes do pick up in the last hour. But even now, as of now, volumes in Reliance are at a 5-month high, the highest since the 1st of July. So quite interesting. Small caps as a part of the market is doing very well, and broader markets are participating. So it's not a narrowing market; it's a broadening market, which is exactly the kind of market that you need. What is down is maybe metals and a few other sectors, but metals primarily, and PSU banks, which have done well recently, are pulling back a little bit. As I said, I mean, it's a good-looking screen, but it's a big thank you, of course, to what's happening on that one name, that is Reliance Industries. Rima, hi.
Hi, but it's still a historic day, right?
Oh, yeah.
Very momentous as the key indices have gone and scaled fresh all-time high levels. And 400 days, it's nearly taken us 400 days for our markets to get back to these levels. But of course, in the last 1 year, the whole composition of the market has changed. Earlier, last year, it was all about these digital names. Technology stocks were at the forefront of the bull run. But this time, it's all about the PSU stocks, as the IT stocks have taken a bit of a backseat. And it's quite commendable, right? In the past, whenever the markets have been at an all-time high levels, it was in tandem with the rest of the global markets. All the global markets have done well. This time, we stand alone on the pole position. Just take a quick check on where the global indices stand and the distance from their all-time high levels. Of course, the biggest cuts have come in Hang Seng China, the Nasdaq, but even something like an S&P 500, a very broad-based index in the US, that's 16% away from its all-time high levels. Dow is about 6.5% away from its all-time high levels. In the European market, the key indices are about 10% away from their all-time high levels. So this time, it's all about India's resilience, the money that the domestic investors have been patiently putting into the Indian markets, why the SIP route. And of course, in the last few days, the decline in crude prices is also adding to that tailwind. So all in all, it's a very historic session. And this time, what's unique about the rally is the fact that India is the only major market which is at an all-time high. We'll discuss all that and more. We've got a lot of big voices joining in. Nigel, my colleague, as Prashant said, is at the Bombay Stock Exchange. So he's going to get the pulse and feel of Dalal Street today. But before that, let's tell you what we've lined up on the show today. The Nifty hits fresh all-time high, shrugs off China worries. The Sensex too continues to trade at record high levels. On the back of this, we had a chat with market voices like Mark Mobius, Shankar Sharma. Key excerpts from our conversation coming up on the show. We'll also be joined by Nilesh Shah of Kotak Mahindra AMC to get his views on the markets. And finally, to discuss the overall macro picture and the top sectoral bets, we'll be joined by Jitendra Gohil of Credit Suisse Wealth Management.
Okay, but what should you be doing if you're trading now that the market's made a new high? Mitesh is with us as always on the top of the program to tell us exactly that. Mitesh, hi, good afternoon. What trades would you want viewers to take?
Good afternoon, Prashant. I think in the morning we talked about buying the dip, and then I've been maintaining that we should test and cross the all-time highs. I think that's happened. Broadly, this is a market which remains positively biased. Now, for long positions, the idea is to trail the stop loss to about 18,490 on the spot and hold on to long positions. And on the stock side, I have two buy calls. You couldn't have missed Reliance today. Big breakout, strong price and volume action. So that's a buy. Keep a stop below levels of around 2660 and a target of 2800 is what traders can look at. And the other one is IGL. It's been on the recommendation list earlier as well in the last few days. But today, I think there's a fresh breakout which has taken place. So buy here with a stop at about 438 and a target of 462.
All right. And big volumes on Reliance as well, Mitesh. Thanks very much. IGL and Reliance, two ideas coming in from Mitesh at this point in time. Let's welcome in veteran Nilesh Shah, is Managing Director, Kotak Mahindra Asset Management Company. He's joining us right now on the program on a day when the market and the Nifty has made a new high. The Sensex did so last week. The Bank Nifty, of course, has been making new highs in any case. Nilesh, hi, good afternoon. Great to have you with us here today. Your thoughts, Nilesh? I mean, now that we are at a high, what next, right? I mean, you are in that sense, uncharted waters with a lot of uncertainty around the globe still very much there. How would you look at things?
So, Prashant, if we look at the last 12 months, it has witnessed a couple of very, very important features. One, this recovery is despite heavy selling by FPIs between October 21 and June 22. Clearly, domestic, institutional and retail investors have come of age. We are in a position to withstand foreign portfolio investors selling in case that arises. The second thing is also linked to domestic economy. Clearly, between last high and this time, domestic sectors have taken the lead: banking, manufacturing, industrial, whereas global sectors like IT, pharma, and metals have not delivered performance. So undoubtedly, as long as domestic investors' confidence stay on long-term India growth story, and our economy continues to differentiate itself vis-a-vis global peers, I think the journey of market will continue forward. Does that mean that tomorrow also we will have an all-time high? Answer is obviously no. Markets are markets. They'll go up and down. But as long as investor confidence and economic performance continue to come, we'll continue to move forward.
Nilesh, afternoon. Sectoral rotation is very common in the markets. 2021 belonged to the IT sector. 2022 belongs to banks and the PSUs. What will 2023 belong to the next 1 year? Where do you think leadership will come?
So if we look at calendar year 23, we believe some of the beaten down sectors like IT and pharma could provide an opportunity. But for IT, the catalyst will be NASDAQ bottoming out and recovery. For pharma, the catalyst will be earnings stroke revenue growth. But subject to that kind of bottoming out of sectors which have been underperforming markets for calendar year 22, the sustenance story should continue in banking and domestic economy related sector. Banks no doubt have delivered great performance in 22. We do expect that to continue even in 23 with NPS coming to historically low levels and rising interest rates supporting the profit margins. On domestic sectors, we believe industrial, capital goods and engineering should do well. as not only the government demand, but also private and export demand will support better volume growth. So overall continuity of performance in banking and domestic sectors like engineering, capital goods, and some entry point over next 6 to 8 months in IT and pharma.
And you will be ready for that when that happens. That's the point. Nilesh, we had Pankaj Tibrewal with us earlier in the program in the morning today, and he was kind of highlighting a little bit of stress which seems to be starting to emerge on operating cash flows. He rattled off lots of statistics, but that one was what he said made him worry a little bit because liquidity in the system is also tightening somewhat. Any thoughts, Nilesh, on this? Because this is happening after quite some time now.
Absolutely. Pankaj made a very, very important point which our researchers are working on. At Kotak Mutual Fund, we observed that in the September 22 quarterly result, the operating cash flows have taken a nosedive. Working capital has increased tremendously. Inflation has also resulted into increases in working capital. And somewhere the rotation of cash from business to business has also seemed to slow down. Clearly, is this a trend which is likely to continue, or is this an aberration? We'll be carefully observing December 22 quarterly results to confirm whether it was an aberration or is it a trend. And in our portfolios, we are putting far more focus on companies which are able to maintain operating cash flow rather than just the profitability. History has taught us that cash flow is the sanity, everything else is vanity.
Very well put, Nilesh. So, I also sort of pressed Pankaj on that point. He said, well, the sectors which are seeing this are metals, chemicals, and cement. But these are sectors which anyway were expected to do pretty poorly, right, in Q2, Nilesh? Or is this a more generalized trend that you're seeing? And what is your own hunch? Is this like a one-off, as you said, or, this could continue?
So our feeling is that to a great extent, September 22 quarter witnessed dramatic drawdown of domestic liquidity, the FX intervention, the festival season demand, which generally increases currency in circulation, and the CRR hike, which continues to, CRR ratios, which continue to take away some liquidity. All those things put together resulted into outflow of domestic liquidity, and that probably is reflected into cash flow of operating cash flow of companies. As I mentioned, we have to wait and watch for December 22 quarter. In my opinion, it might be an aberration and not a long-lasting trend. The circulation of money should start improving as FX reserves have started going up. FX outflows, which were taking domestic liquidity out, will be converted into FX inflows, adding to domestic liquidity. So hopefully operating cash flow should start improving in December 22 quarterly results.
Okay, so the shrinkage in operating cash flow is perhaps an aberration, but we will wait to see what Q3 earnings show up. But Nilesh, if it's not, what is the signaling from this contraction that we've seen in operating cash flow in these particular sectors? And if in Q3 as well, the picture is fairly bleak on this cash flow front, does that mean that people should remove these stocks and sectors from their portfolio?
So undoubtedly, today Indian markets are trading at a marginal premium to its long-term average and a substantial premium to its emerging market peers. In order to justify those valuations, one has to deliver better performance. In some sense, Indian market is like Surya Kumar Yadav. No matter what the pitch is, no matter what the bowling is, you have to deliver because there is expectations from number one T20 batsman in the world. If operating cash flows are not reaching to investors' expectation, then there is potential of derating in the valuation. And we'll have to keenly observe in which sectors, which companies stress on operating cash flow is becoming, endemic or long-lasting. Vis-a-vis where it is a temporary aberration. I think next year's return will come from those investors who are able to bet upon companies whose operating cash flow is not disturbed or reduced despite current situation.
All right, Nilesh, appreciate you sharing those thoughts with us. Very useful, very interesting. Thank you so much for joining us here on the program on CNBC TV 18. As you said, Cash flows are sanity, everything else is vanity. Well put. Nilesh Shah of Kotak Mahindra Asset Management Company there. 82 points on the Nifty. We're at 18,594. So just under the highs by about, 15-20 points or so. We'll take a break, the first on the program here. On the other side, my colleague Nigel is standing by at the Bombay Stock Exchange with Deepan Mehta. And we'll get you the conversation, the buzz from the BSE on the other side of this short break.
Welcome back. You're tuned into Closing Bell. Well, normally we get you coverage and I normally join you all from the news flow. But I said since it's such a big historic day, why not visit the BSE? And to give me company out here, Deepan Mehta, Riva as well as Prashant, I'll tell you what, it's a historic day. And Deepan says that he's got a lot to tell us. So I think all our audience should be focusing into this conversation. Deepan, who would have thought, man? The Nifty at around 18,000, 18,500 odd, the Sensex more than 60,000 odd. You would have seen both these two indices at a tenth of what they were at that time, right? I mean, it's a few years ago, and you'd rather not remember that.
That's right.
But tell us, what's the way ahead from here on?
It's a great and joyous moment for the stock markets. Back in 2000, Nifty was at 1800, Sensex was 6,500, so 10x gains in about 20 to 23 years or so. And we have had a superb wealth-creating opportunity.
Yeah.
And going ahead also, I think that it's going to be a fabulous wealth-generating machine for the Indian economy, for the Indian public as well. And frankly, I think we're on the cusp of a massive takeoff over here.
Right. Deepan, a lot has changed though. You have been tracking the markets for many, many years. And there have been some big changes that have taken place, right? Notably, the FI is selling. If someone said that the FIs in the last 1 year are going to sell billions of dollars, well, you would have said the index should be down by 25 to 30% odd. Now, that's not happened. And there have been a couple of other structural changes as well that have benefited us. Run us through the list that you have.
See, Nigel, ever since I joined the market, there were three things which I had no control over and had caused tremendous sleepless nights. Coalition governments, FI selling, and oil prices.
Right.
These were structural problems with our economy and with the stock markets. Coalition governments, thing of the past, thanks to BJP, which has been so proactive and which have undertaken so many reforms.
Right.
And they listen to the market and the economy.
Right.
Second is FI selling. I would never have thought that FIs could sell so much and Indian retail public could absorb so much of their stock. And it's a great development, and it has changed the trajectory of our market forever.
Right.
Third is oil prices. Right now, I think the trigger today is lower oil prices. And of course, we don't have much of a control over oil prices going forward. But at least the government is not subsidizing oil prices or petrol and diesel prices the way it was earlier. It gets passed through.
Yes.
Inflation is something which we have been dealing with since independence, and we'll continue to deal with it. We're becoming the experts in the world, I would say, when it comes to inflation. So that's something which will happen from time to time. But these three structural issues have been completely resolved, hopefully forever. And that's put our markets in a different orbit, I would say.
Yeah, that's right. And what about the Chinese markets? For the last 1 month or so, they were grabbing all the eyeballs. This morning, if you woke up, you said, well, the Asian markets are in the red. But it actually proved to be a blessing in disguise, right? Because if there was some money that was finding its way to China, suddenly they say, no, let's stick to Indian markets. The fundamentals are far better. You get earnings growth. You have a stable government. Crude oil prices lower as well. So, things are looking pretty much up for the Indian markets. But what's the way from here on? There are some cautious voices that are coming up there, maybe with good reason as well. We're not trading cheap. You have another market like some of our peer comparison, like the Chinese market, which is trading at nearly half the valuation that we are trading at. And also, could the global economy itself go on for a bit of a tizzy? Do you think 2023 could be a bit of a somber year for us?
See, Nigel, many things can go wrong.
Yeah.
Okay. But any investor should be prepared for a 10-15% correction at any point of time. But this is the age of India. China, I think, best days are perhaps behind them.
Yeah.
And we are seeing a surge in retail investments coming in. Corporate earnings are flying over here, I would say. And what fabulous listings are taking place, the kind of choice we have in our markets, the new listings taking place, the type of companies coming in, so many outstanding businesses getting listed. And I know valuations are on the high side, and that's been the case in India for the past several years. You never get a stock cheap.
Yeah.
As I was telling you in the break, I've never seen Asian Paints at 25 times P multiple. It's always expensive, and still it does create a lot of value.
Right.
So there's nothing to be perturbed about that. And there will always be risk factors. There will be concerns. But, bull markets climb the walls of worries.
Right. Deepan, you're in the mood today, right? You're finding the The perfect, yeah, finding the rhythm. Looks like you're seeing the ball big as well, and you're smashing it out of the park. So a lot of our viewers out there would like to know, Deepan, which are the sectors that look good even from here on? There's been a consensus buy on banks, financials, and that's worked out. What's your sense? From here on, what could do well?
See, I think we're very positive on banks. Whenever they take leadership structure, because of the high weightages in the Sensex and Nifty, these indices also start to do pretty well over there. You have a great deal of choice when it comes to bank, depending
what
upon
about
your
the
risk appetite.
PSUs?
I think PSUs are a great trading bet for the next 2-3 years or so.
Okay.
They are playing catch up. They've been underperformed for the last 15-20 years or so.
Okay.
And they are playing catch up. This is a great time for them because economy is doing well, so there's good demand for credit. And because they are PSU, they can raise resources at very cheap interest rates.
Right.
And the NPA cycle has not started for them, so credit costs are going to be low. So yes, you're going to see a re-rating of the PSU banks, price to earnings, price to book multiples as well.
Yes.
But if you want like a 5-10 year investment, then you have to stick with the HDFCs, the Axis Bank, the Kotak. They have gone through the ups and downs and still come out very strong. So banking is a cyclical industry, and this is a great upcycle for them. On the other hand, we like automobiles a lot, and all related to auto ancillary as well. Transportation sector as a whole should do pretty well. Capital goods, I think after so many years, we are seeing such bulging order book positions.
Yeah.
Good margins coming through over there. Great earnings visibility.
Right.
And fabulous choice. You have the PSU, capital goods manufacturing company, you've got defense over there as well. And you have the Indian engineering construction companies as well. So there's a lot of choice. Nigel, the only thing perhaps to avoid is materials. Other than that, I think every industry, every sector is in its own beautiful groove.
Okay, let's talk about both these two sectors, the autos and the industrials. From the autos, I mean, there's a wide spectrum of stocks out there. So would it be the CVs? Would it be the PVs? Two-wheelers, I think they haven't been getting too much attention. How would you play that theme? And you briefly mentioned auto ancillaries. So from there, if you could name a couple of stocks?
Four-wheelers, that's where you have to be in.
Okay.
CVs, tractors, passenger vehicles. Personal preference, passenger vehicles.
Passenger vehicle. Maruti,
Mahindra and Mahindra.
Okay.
Two-wheelers, something which you always discuss, Eicher Motors.
Yeah.
We like the bikes, we like the stock. And it's a different story altogether. You cannot compare it to the likes of Hero or Bajaj. They are a different, they cater to a different consumption audience over there. Then auto ancillary, I think they are great auto ancillary companies, particularly with usual disclosure that we and our clients are invested. The Minda Corporation, Minda Industries, they've done very well.
Yeah.
Bharat Forge comes to mind, and there's Sona BLW as well. Basically trying to focus on companies which are neutral when it comes to the passenger vehicle, whether it be it EVs or be it ICE engines.
Right.
So I think you're pretty much fine in all of these sectors. There's the secondary market for them as well. And auto ancillaries are neutral to the success or failure of a particular model.
Yeah.
So we like that particular sector as well.
Okay, all right, Deepan, we made a note of that. Well, Reema and Prashant, I'm going to toss it back to you. I hope our viewers enjoyed that conversation. Well, Deepan Mehta, he says he's not seen the index go up 20-30% odd. He's seen 10x on the index itself. So imagine the way some of the stocks have moved. Back to you guys in the studio.
A great conversation, Nigel and Deepan. Thank you very much for that. Let's also invite Jitendra Gohil, the head of India Equity Research at Credit Suisse Wealth Management, on the show now. Jitendra, afternoon, and thanks so much for joining in. Are you seeing any signs of fraud frenzy, which is typically associated when markets hit all-time high levels? And if that's not the case this time around, do you get the sense that perhaps markets have more legs to go on the way up?
Hi, Rima. Thank you for inviting me on your show. First of all, our investment committee has decided to stay neutral on India despite 110% valuation premium versus emerging market. That shows the confidence in underlying fundamentals. Definitely the valuations for Indian equities is higher, but we are nowhere close to bubble kind of a territory. So while we are cognizant of the valuation is running a little higher, we believe that there are a lot of opportunities. And coming back to your questions, typically what we see is that the cash position with the mutual fund is at a little elevated level. If you look at the FPI holdings of Indian equities at around a decade low levels, so at least around 17.9% of FPI holding, which is 10-year low. And the retail investors haven't levered to the extent possible, but we haven't seen the froth in that segment as well. The VIX is falling down. So I don't think we are yet to a level where we have to be extremely worried about valuation match. And the second point also, one has to understand that while the markets looks all-time high, there's a lot of opportunities there. Look at some of the NBFCs, which are trading 52-week, closer to 52-week low. There are certain consumption-related stocks which are trading 52-week low. So I think there could be a good rotational opportunity within the sectors. And I think that's where we feel that still valuations are elevated, but still we are not extremely worried about the kind of froth in the market.
Right. Jitendra, sorry, NBFCs and some consumer names you mentioned, right? Good afternoon. Yes. I mean, without naming names, if you don't want to, can you be a bit more specific?
See, I think first thing is that there was a nice trade among the market participants that buy banks, sell NBFCs because the yields were going up. NBFCs actually depend a lot on wholesale borrowing, so that borrowing costs have gone up. So we think that sooner or later the interest rates globally will have to fall because we are looking at the Fed, which is going to slow down on their rate hiking cycle. So we have seen US interest rates have started falling, Indian interest rates have started falling. So I feel that some of the gold finance companies, for example, which have been trading at 52-week lows, I think those look little attractive to us from a valuation perspective. Secondly, I think some of the wholesale lenders to housing related segments, they have been beaten down badly. And I feel that there could be some kind of opportunity emerging as we remain positive on housing sector as a whole in the next few years or so. So it's a structural trend. We think that some of the NBFCs related to housing finance or related to developers should do well in the next few quarters or so.
Housing finance and gold loan NBFCs perhaps are looking attractive. Jitendra, do stay on. We've got a very important oil and gas story to track right now. We learned from sources that the Kirit Parikh committee will recommend complete liberalization of natural gas pricing by January 1st, 2026. Parikshit is here with the details. Parikshit?
Well, yes, sources telling us that the report is now in the final stages. It will be submitted to the government by the 30th of November in the next 2 days. The draft report has been circulated among all the members. It will be finally adopted tomorrow before being shared with the government. The big recommendation is complete liberalization of natural gas pricing by 1st January 2026. So there could be a roadmap there. At the same time, we believe that the committee has suggested price caps for APM gas, which includes ONGC and OIL. At the same time, the committee is not likely to suggest any change in prices of gas from difficult gas fields. So while we're awaiting the contours, we believe that there will be a formula suggested for APM gas and there will be no change in formula for consumers of piped gas as well. This is what sources are telling us. We will get more clarity on this in the days to come, but this report will finally go to the Union Cabinet and that will take a final call on this.
Okay, Parikshit, thank you very much for that, and we'll sort of get back with Parikshit with more details, as he said, as he gets them. Jitendra, the big gainer today is Reliance Industries, some 3.5%, big contributor to gains. You heard my colleague Parikshit talking about what the Kirit Parikh committee is recommending on gas pricing. Any thoughts?
So from utility and oil and gas perspective, what we believe is that we are more tilted, our portfolio is more tilted towards gas utilities. We think that as the gas prices have started correcting globally, as well as the oil prices have started falling. So we are positive on consumers of gas and oil, whether it's tile companies or whether it's gas utilities, to some extent even fertilizer companies. These all companies that we are looking at, and we are a little bit overweight on this sector. Yeah.
All right. Hi, Jitendra. Good afternoon. Thanks so much for speaking to us here on CNBC-TV18. Well, I'm just looking at your sectors of preference, and I find pharma in there. That's really not participated actually in the big run we have seen the last 5 years or so. Do you think most of the bad news now is factored in? Because some of these stocks on a forward multiple also are not looking very cheap. Your take?
Pharma, we went overweight few months back, and our committee decided to maintain a little bit positive view on pharma sector. There are two reasons to it. One is generally during global slowdown, there is buying interest towards the defensive sectors, and pharma being one of the defensive sectors. We think that the valuations also not that expensive, and hence we are continue to. We maintain our positive view on pharma from a defensive side. Within the pharma sector, we think that the domestic pharma names are looking a little bit more attractive, and hence we continue to remain a little bit overweight on pharma sector because of its defensive appeal. Yeah.
All right, Jitendra, final question from my end before we let you go. Everyone's celebrating all-time highs. Unfortunately, some of those IPOs that came in November 2011, for many people who subscribed to that or bought it at some point of time, well, they'll be pulling out their hair. A lot of these stocks have come down considerably. Some of these businesses are very good, but the valuations are very elevated. At these prices, are some of these themes looking exciting?
This question keeps coming to us every time, and what we have been recommending to our investors to stay away from this sector. One or two companies we do like, but we are extremely cautious about this sector because a lot of money has been already made before this IPOs came to the secondary market. So I think still we need for these companies to actually give us more guidance, more color in terms of how they are going to be profitable, and then probably it will look very attractive to us. But as of now, we are just observing these companies. We are not heavily invested in these all companies as of now.
All right, Jitendra, we'll take a quick break at this point, and we'll come back. As always, we'll get you a check on what dealing rooms are talking about in our segment, D-Street Chatter. We'll also get you by BTST trades with our technical expert in a bit from now. 30 minutes to go for market closing.
Welcome back. Up about 63 points in the Nifty. So we've retraced a bit after getting to levels of 18,600 thereabout. The biggest contributor to the up move today has come in from the auto sector. The auto index is higher by close to about 0.7%. The price hikes by Hero MotoCorp aid. The company is going ahead and undertaking its fourth price hike. And going by the management commentary, they appear to be quite positive that this will be absorbed by the markets because they indicated that the economic landscape appears to be such that industry volume should pick up from here on. So they're quite confident that the price hike will be absorbed by the markets without impacting volumes or demand. But let's get to our segment, D-Street Chatter. Nimesh is going to get us into an insight into dealing room chatter, as well as a few tidbits about stocks that are up and about in trade. Nimesh?
Hi, Rima. So markets are at record highs, but it's business as usual at the dealing desk. So not much of excitement from the larger institutions, but today's number could look largely because there is an MSCI rebalancing. The impact is today, so close to $400 to $5 million is because of the MSCI rebalancing. And on top of it, there is a small market at close basket buying as well. Some of it is also because of the MSCI rebalancing. So that may have an impact on the FI numbers today. The good part is that there is now participation in the broader market. So the mid-cap index is starting to outperform. Even in today's trade, it's up over 0.5%. And there is a lot of traction now in the mid-cap and small-cap space. So that seems to be a good thing, largely from a participation point of view, from the retail and HNI investors as well. I guess from a sector point of view, two things stand out. The metal index is under pressure because of renewed concerns in China. So that's where there is some bit of profit booking. But as I said earlier, the big theme seems to be in the mid-cap and small-cap, and that now stands to outperform. In fact, a couple of technical guys have also put out notes saying that maybe from here you'll see a big breakout in the Nifty small-cap index. So that's where the action seems to be. But a couple of things. One, there could be a large number because of the MSCI rebalancing. But I guess there is some bit of interest back in the broader markets now.
There is some amount of interest back in the broader markets. Nimesh, in terms of specific stocks, what are you picking up today?
Hi, Prashant. So in terms of individual names, the first stock is Ami Organics. There was a large block deal in the 2 o'clock trading window. Almost 3% equity has changed hands. And I believe one of the leading long-only fund was a seller in today's block. and could be multiple buyers from the domestic side. So this is one stock to watch out as far as disclosures are concerned. The second stock is RVNL. Huge move in that stock. In the last 1 month, the stock is up almost doubled, and even now today the stock is locked at 10% upper circuit. Huge volumes in today's trade, and there were multiple blocks as well. Looks like the HNI community seems to be quite active now in this particular stock. The third stock is Birlasoft. Again, a small cap, mid cap company. Looks like some bit of buying interest is back in that stock, and hence that stock is buzzing in trade today. And the last stock is Syngene. Mildly under pressure today, but again, there is a renewed buzz of a large block deal in Syngene coming soon. And remember, there is a strategic investor who might sell a large chunk. So that's a buzz on Syngene, and hence that stock is mildly under pressure today.
All right, Nimesh, thank you very much. Interesting list as always. Appreciate it very much. Mitesh is with us now to tell us what to buy or sell today for a reverse trade when we come back tomorrow. Mitesh, over to you.
I have a BTST on Tata Consumer, Prashant. I think that's a stock which had a positive news flow when the Bisleri announcement was made. And then the stock was sideways after that breakout. So I think today's seeing follow through. This could go further high, and I would recommend a stop at about 795 for target of 820 in a day or two. And the other one is Bandhan Bank reversing from extremely oversold levels, though it's not done very well, but maybe some kind of short covering led trading bounce back can happen here. So BTST with a stop at 221.5 for targets of 229, 230.
Okay, all right, got that, Mitesh. Well, we'll come back to you for a final closing trade, but we have Ambrish Baliga, market expert who joins us on the show. Hi, Ambrish, good afternoon. What a move, right? I mean, all-time highs, who would have thought about it? Everyone's talking about valuations, FI is selling, but the markets seem to be finding only one direction, that's upward. That said, I was just having a chat with Dipan Mehta, and he was saying that, Asian Paints was never available at around 25 times odd. But I believe you like the stock even at 55 to 60 times. Go ahead, tell us more.
Absolutely, because see, I mean, that's the market leader in paints, and that too not for the last 10 years, 20 years, for the last 54 years. And the best part is it doubles its top line every 5 to 6 years. And if you see on the last 3-year basis, Asian Paints has outperformed the industry growth by reporting a volume CAGR of about 20%. So the strong volume growth is due to the market share gains, dealer additions, and strong demand traction in Tier 2 and Tier 3 cities. And I suppose in addition to that, there's a pent-up demand from the B2B segment, which is about 20% of the sales. And if you see in the last couple of months, the key raw material prices are corrected. And I think this should help improve the margins. And they're also planning to aggressively have product launches and continuous expansion of its retail touchpoints. In fact, the plan is to have 5,000 new retail touchpoints every year. And this will drive the company's decorative paint volume by a CAGR, I think, of about 15% over the next 3 years. And I'm not too worried about these large business houses with deep pockets getting into the paints business, like JSW or Grasim, as I believe it will be difficult to challenge the leader. I mean, they could eat into the market share of the smaller players like Indigo, Shalimar, as well as a number of local regional brands. But then, eating into Asian Paints, your volume, I think, could be a bit difficult. It is just like Asian Paints getting into kitchen, bathware, and white cement segment. That is not going to move the leaders in, like in those segments. So I believe that at these levels, there's a lot of value. The downside is quite limited, and we've already seen the consolidation. So looking at FY24 EPS of about 60, I have a target price of about 3,900.
Ambrish, afternoon. What about Reliance Industries? What explains this phenomenal 3% up move that we've seen in Reliance Industries? Very high volumes, because typically a decline in crude prices is not particularly positive for Reliance Industries. So what's the market sussing? Is this the liberalization, the potential liberalization of natural gas? But that's going to be effective only in 2026. So what's the market talking about, Reliance?
See, when you have the management and Mukesh Ambani coming and talking about the futuristic growth, the plans, and the sort of opportunities which are there for Reliance, I think that trickles down to investor buying finally. And that's what we have seen in the last couple of days. The way the management spoke about the future opportunities, I think that's what is playing out. In fact, for Reliance, in fact, I have a price target of about 3,200, but not immediately, possibly over the next 6 to 8 months.
No, got that. That is Reliance in focus. 60 points now, by the way. So the market's come off a little bit. 18,570 is where we are at. And the high today was 18,614. So some 45 points off the high, which was made earlier in the day at about 140 or so. So that is the space which is looking good. By the way, market breadth, which was very comfortably almost 3:1, is also closing in. 1,300 stocks are higher and about 900 stocks are lower now. That is NSE advanced decline ratio. Through the course of the day, it's been coming closer and closer. Amrish, RVNL, and I was just speaking with Nimesh earlier, 100% this month. It's just an incredible run. Now, the point is, the question to ask is how many owned it and how, did they own it in size? Because very, very difficult, right, to suddenly kind of get in the middle of it, and if you've never tracked it, or if you've not owned it, you don't know the history. I mean, it's good to mention that stocks are going up, but how many would have actually bought it? Your thoughts?
I mean, I don't know how many investors would have bought it, but then when a stock starts moving like that, you normally have traders getting into it, and that's basically based on technicals. So they won't even know as to what the company does, but based on the momentum, you have a lot of speculators and traders getting into it and exiting, at least getting a decent sort of a return. But I doubt whether there would have been too many investors who would have bought it at the right time and had ridden this sort of a rally.
All right, Amrish, stay with us. We'll just come back and pose a few more stock-specific questions your way. And as we slip into a break, let's hear out some important opinion that we got through the course of the day. Mark Mobius is someone who we spoke with. He, of course, runs Mobius Capital. We also had Shankar Sharma with us, who remains very positive from a 3 to 5 year perspective. Listen.
As soon as we get more money and we put more into India, plus we diversify. Turkey, we're putting money into Turkey, we put money into Brazil and others. But at the end of the day, India is going to be the bright spot from a long-term perspective. But of course, one constraint for India is government regulation. As you know, for foreigners to come into India, there's some bureaucratic steps that have to take place. And the degree to which Mr. Modi is going to eliminate these barriers will be a big plus for the market. And I know he's working on that. He's programmed to speed up the improvement or the agreement process is very, very important.
India is a standout market, I think, not just, in the last 1 year or 6 months. I think it's going to be a standout market for the next several years, could be 2, 3, 5, 10 years. I mean, I don't think any other market will compare, if ticking all the boxes. I'm absolutely clear. There will be obviously ups and downs, that's part and parcel of the game, but at every point out into the future, India will be standing out as a clear outperformer. And, but then the way I invest is that, not always all eggs in one basket. And, Turkey, I bought about 2 months back the ETF, which was 33.24. It's up 40% as a market in dollar terms in 2 months' time. So that is working out well. I think India and Turkey, if you ask me, both very similar countries, both great industrial powerhouses which have been shadowed by China. They are now, coming into their own. And India, of course, is way ahead on all macroeconomic parameters.
It's now, and a bulk fit has come through in the IT space. So the Nifty IT index has given up close to about 1% from the day's high. So just pull up that intraday chart and you would see, and that's perhaps brought about the Nifty decline from levels of 18,600 plus to now 18,550. The Nifty IT index is now down in the red. A couple of other stocks which are under pressure today. Many of the metal names are weak. Hindalco, JSW Steel as well as Tata Steel are down between 1 to 2%. Perhaps the weakness in China, the continued lockdowns and the impact that's going to have on demand. HDFC Bank too is lower by close to about 1.25%. That's a heavyweight which is struggling today. Let's also get you some important opinion. Earlier today, we caught up with Santanu Sen Gupta of Goldman Sachs, and he says the worst is over, the dollar is near its peak. He also adds that growth capital may continue to chase India. Listen in.
Broadly, the capital expenditure view is not just contingent on the government spending on capex. I mean, one, the government has spent 1.5% of GDP pre-COVID cycle to about 3% of GDP now. So that's almost a 1.5% of GDP increase that you've seen in the central government's capital expenditure. But there are a couple of other things which are going on in the capex cycle. One is that the manufacturing companies have deleveraged over the last many years, but especially into the COVID cycle as well. The manufacturing companies have deleveraged, so balance sheets of those companies are looking better. Capacity utilization is reaching closer to 75%. We are still looking at the current account deficit in the region of 3 to 3.5% of GDP, both this year and into next year. But what has changed is, in our view, the dollar is peaking out or is nearing a peak in the next couple of months or so. As the market starts to price in where the Fed cycle terminal rates will be, that is possibly when the dollar peaks. Once that is over, then emerging market central banks will find it much easier and will have higher degrees of freedom to operate even with lesser reserves. We think that the risks are fairly balanced at this stage. The upside bias in the second half could come if Make in India really plays out. So the PLI schemes gain traction, and you have a lot of FDI flowing in that causes the investment cycle to grow faster than what we are anticipating. That can cause the upside risk as we head into the second half of next year.
Well, we have come off a little bit from the top, but it's a historic day nonetheless. Amrish Balika is still standing by. Amrish, one stock you mentioned a couple of weeks ago was IRFC. And what a move that stock has had. It's up close to around 50% in a month or so. What's your take on the stock? What's the fresh call now at these levels of around 33, 34?
So honestly, this stock did not move for about 2 years, and we are just wondering as to where we have gone wrong, because it was a no-brainer. I mean, a company growing at about 30-35% Y-on-Y for the last so many years, especially the last 2-3 years, and the stock was just not moving. Extremely good dividend yield of about 7.5-8%. But then when it started moving, I think it did whatever it had to do in the last 2 years. It did it in about a month and a half. But at these levels, I mean, closer to about 34, 35, where it reached this morning, I think it's, more or less getting fully priced. So those who have bought it at those 23, 24 levels when I recommended, I think one should book out to a certain extent. Maybe about 50% of the position should be booked out.
Amrish, the big deal which is brewing in the consumer space is the potential acquisition by Tata Consumer of Bisleri. The valuations are known, 7,000. We know the synergies because Tata Group already has a presence in bottled mineral water. But at the current price, at these valuations, what does it mean for Tata Consumer?
The Tata Consumer was on our buy list, but then because of this acquisition, we are reviewing it because we believe that with Bisleri's estimated turnover of about 2,500 crores and a profit of 220 crores, nearly 3x revenue, I believe, is a very expensive acquisition. And this may not really provide those incremental margins nor the ROE in the near future. And the space has a few very well-known, strong competing brands, as well as you have a numerous number of local brands. Since absolutely there is no entry barrier for this business. And we have seen Tata's had acquired a Himalayan brand about 2 decades back, which again remained a niche market at the upper end. Whereas they also had introduced Tata Copper for the mass market, which again is yet to make those inroads. But buying something like a Bisleri at about 7,000 crores, I think is just a bit too expensive. And like I said, we'll be reviewing our call on this stock.
By the way, just take a look at the move JK Tyre has made. JK Tyre is now up close to about 13%. So this tyre sector as a whole has been on fire. Early in the morning, it was Apollo Tyres after UBS came out with a note and pegged the target price at 355. So that's an up move of still 15% from where the stock currently is. But JK Tyre has completely taken off right now, up close to about 13%. Ambarish, the best of the raw material price decline is yet to reflect in the margins of many of these, tire companies. Is this a space which is looking attractive to you? And auto demand, as we know, continues to remain very robust.
No, I mean, this was looking extremely attractive earlier, but then about 2-3 weeks back, we believed that it was more or less fully priced. But then now looking at the way the oil prices have come down, I now believe that there is at least some value left. I mean, it may not be a, say a 30-40% sort of a move from here, but then stocks like Apollo or JK Tyre can possibly give another 10 to 15% move from here because the way the raw material prices, especially oil, has fallen.
All right, Ambarish, earlier today I just put out a piece on Piramal Pharma. I'm not sure whether you've tracked that. It listed at around 200 rupees. It's at around 130 rupees. The street was very, very disappointed with its margins. In the past quarter, it was only around 12%. Valuation-wise, though, if they go ahead and achieve what they are set out to, that's revenues of closer to around 10,000 crores with margins of around 25%, then the stock effectively is trading at around 8 times EV upon EBITDA, which I dare mention is the cheapest among all the pharma stocks. Could be for a reason. What's your view on it?
No, I think one should surely look at buying at these levels because, I mean, one, if you look at the sort of earnings which were reported, people were no doubt disappointed, but I believe this could be one-off and they should be able to achieve what they had set out to. And the way the stock has corrected, I mean, I think it listed at about 220. And at that point in time, we are saying that if it goes to 260, 280, it will possibly get fully priced. Instead, it has nearly halved from there. So I think at these levels, one should be buying. There is not much of a downside from here. And one only requires some patience, maybe at the 12 to 15 months. We should see those levels of about 240, 250.
Okay, all right, Amrish, we'll leave it there. Thank you very much for your time. Great speaking with you. And it's a pleasure speaking to you as always. Well, the market by close has come off quite a bit. Just 36 odd points left on the index after making a new high. So this is, a pretty sharp fall. The high of the day was made, of course, at about 145. The high was 18,614 or so. And we leave off at 18,549. So that's about 65 odd points below the day's highest level. And let me just quickly run you through pockets which did, which did better, which did worse. Metals, of course, been down and out. They end as the biggest losing sector. IT services joined that pack, about 0.25% down. And the CPSE, the government pack, but that also came off. Oil and gas with about a 1.25% gain, and energy with a 1.25% gain. They were the big gainers. Small cap index, I think, no such problems with the index continuing to do better and better. It closes not at the day's high, but very close to the day's high. And I think same is true for the mid cap index as well, which did not sell off at all like the Nifty did towards close. Let me just look at the Nifty 50 contribution list, because when we started, it was all Reliance. It, by the way, still is Reliance. Think about this. The Nifty ends 40 points higher. Reliance contributed 68 index points to the Nifty, which means that on the other side, there was a fair bit of pressure which was coming through from names like HDFC Bank, Infosys, HDFC Limited, and so on and so forth. Rima.
Well, the mid-cap index and the small-cap index outperformed. The advanced decline ratio narrowed, but still in favor of the gaining side. Remember, while the mid-cap index is just about 1 to 2% away from its all-time high levels, the Nifty small-cap index is about 16% away from its all-time high level. So in that sense, it still has some ground to cover. Oil marketing companies higher in trades, HPCL and IOC up and about. Tire stocks had a late rally. So JK Tyres up 12%, CEAT up 7%, Apollo Tyres after that UBS note, Apollo Tyres gained close to about 6.5%. Rail stocks like RVNL, TexRail up and about. MMTC gained. MMTC was up nearly about 8.5%. You also had strength in names like Delta Corp, which moved up 5% on very large volumes. On the losing side, many of the metal names, which are large companies but outside of the Nifty, like SAIL was down close to about 1.5%, and IEX, despite details coming through on the buyback, IEX came in for some profit booking. Bank of Maharashtra, PNB, Central Bank, a couple of these banking stocks which had a phenomenal rally in the last 3 weeks, in the last 1 month, were a bit subdued in trades, ending in the red. But it still goes down as a very momentous day. We're not closing at those record high levels of 18,614, but we sure did hit it after a gap of nearly 400 days. With that, it's a wrap and closing bell. Don't go anywhere. On the other side, CNBC-TV18 pays tribute to India's big bull, Rakesh Jhunjhunwala. The second part of Remembering the Rakesh series comes up next.